Hello, my name is Tunji Tolulope. I'm here to talk about withholding tax. So, according to my notes, I said withholding tax deduction is a tax deduction at source from payments made to taxable person for the supply of goods and services. It is not another form of tax, but simply an advanced tax payment of tax, as the withholding tax deduction at source is offsettable against any subsequent tax liability that may be due in respect of other income. In certain cases, the withholding tax deduction at source is the final tax in the hands of the recipients. It means when you get a project, the person giving you the project needs to remove withholding tax on the income, because when you give the organization your schedule, your pro forma invoice, there will be places for workmanship, we place for expenditure, then we places for expected income. So in that expected income, the taxable person, which is the person giving you the project, will they have the rights, that obligation is not a choice. They need to remove certain percentage depending on the kind of project, depending on the types of projects that they're giving you. They need to remove a particular amount, a particular rate, and depending if they are giving it to individual or they're giving it to company, different rates. So we have peculiarities of withholding tax. A taxpayer has no options as to whether to pay it or not, as a person making the payment is statutorily required to deduct. I said it is compulsory, it's not an obligation. So failure to do that will attract sanctions, penalties, fees. So they said it is an advance payment of income tax and can therefore be utilized as tax credit against income tax liability for the year to which the income relates, and any unutilized withholding tax may be carried forward and set off against income tax of future years. So when they deduct the money, they only deduct the tax on your expected income, not on the total, not on the total amount of the project, on the expected income. So in instances whereby the expected income is lesser than the income that you arrived, that you later get, the 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 pro forma invoice is like a budget. It's something that is not actual. So at the long run, when the actual income is lesser than the pro forma invoice you gave, it means you have tax income. It means you have tax income. It means tax people as it means the what I'm trying to say is that if you give me a project to help you with a particular road, and I gave you a pro forma invoice that I'm going to spend 1 million on the project expenditure. Inside the expenditure, I'll put my own workmanship there, my own consultancy. It might be consultancy fee, it might be um construction income, it might be anywhere. In this our transactions incomes under withholding tax, we have royalties, we have rent, we have interest, we have dividend, we have director's fee, we have consultancy fee, we have professional fee, we have commissions, we have technical and management fee, we have construction income, we have agency arrangements, we have contract of suppliers. In terms of dividend, dividend is always uncertain. The dividend is always, let's give them this and we'll give them this. But in terms of a project that we have not have the actual expenditure, we cannot ascertain the actual expenditure at the moment where they are going about with the project. They are just deliberating on budgeted expected expenditure. So at the long run, when they have the actual and it affects the income, let's assume you're expecting 10,000 naira income, and you paid 5%, or you paid 10% to tax, you paid 100 naira, and at the long run you realize 8,000 naira income. It means the money that the tax people are supposed to collect is 800 naira, not 1,000 naira. So which means tax are owing you 200 naira. That is what we call tax on credit. So what is 200 naira? tax will not give it to you back. You have to use it to offload a particular tax liability for that year. In the situation whereby you do not use that tax credit for that year, you can't use it again. You can actually use it to offload tax liability for that year. But if you don't use it that year, you can't carry over tax credit of withholding tax. That's what it means. So they said it represents the final tax in certain cases. In certain cases, once they remove it as it's in dividend, once they remove that 10%, that's because the dividend most times doesn't change. So we've talked about the types of the income. We have royalties, rent, and co. We have different rates for individuals and companies. So let's move to computation of withholding tax. Here is a computation of withholding tax in Nigeria. According to the rates, let's assume we are asked to we are given a dividend of 1 million naira, and according to my notes, dividend under individual is 10%, while dividend under company is 10% too. So when the director agree to pay 1 million naira to dividend holder, like shareholders, they agree to give them 1 million naira. The accountant will credit 900,000 to the account. That is net. You are giving them, you give them dividend net. It means we have removed withholding tax. It is compulsory, and since you since the shareholders need to be informed, so they won't go and pay another 10% again. So let's talk about remittance. We have to remit it to the FIRS within 21 days of deductions. Failures to do that attract penalties. So let's move to the procedures for remitting withholding tax and the relevant tax authority. Procedures for filing withholding returns. It is expected that a schedule of withholding tax payable should be prepared by applying the correct withholding rate on each transaction or payment made during the month. It means when we have income in 2 to 3 places, let's assume we have consultants to pay, we have professional fee to pay, we have dividend to pay. We don't lump sum them together. We don't add them together and remove withholding tax on them. We remove withholding tax on them differently, especially when they have different rates. So they said therefore a check for the amount due to so therefore a check for the amount due to the FIRS is raised and forwarded plus the withholding schedule in both soft and hard copy to one of the approved collecting banks for processing. It means withholding on VAT should be paid separately and should be highlighted that this is withholding VAT. The withholding VAT schedule is then uploaded onto the FIRS portal, and once accepted, an electronic receipt is generated as an acknowledge that the process is successful. Therefore, the bank submits copies of these withholding schedules and evidence of payment at the local FIRS office to processing of both the bulk receipt and individual receipts. The relevant tax authority for collecting withholding tax, we have the SIRS, which is the State Revenue Services, and the State Internal Revenue Services, and the FIRS, which is the Federal Inland Revenue Services. So why the SIRS collect withholding tax due from individuals and unincorporated businesses entities residing in the state during a year of assessment. The FIRS collects withholding tax from amounts due to corporate bodies, military and police officers, external affairs offices. However, with effect from 2015, the FCTIRS is responsible for collecting withholding tax from non-residents and residents of Abuja. In the case of saving interest, the relevant tax authority is the tax authority of the place where the branch of the bank paying the interest is located. So the withholding tax will be the withholding tax schedule will be made, but in some instances it will be paid to different organizations on the type of withholding tax, the type of the classes of who we gave the project to, whether it is individual, whether we are doing it for individual, we are doing it for company. In terms of individuals and on corporate business, it means file their WHT and send it to the state internal revenue services, while the real company itself and um, the corporate bodies, the military and police officers, the external affairs officers are however sent to FIRS. So let's talk about the implications of failure to deduct withholding tax. So you if you approve a project to an individual or a company, or you decide to pay your dividend to your shareholders and you refuse to deduct withholding taxes, these are the implications on it. So I said in Nigeria, failure to deduct withholding tax or remit it to the authorities has significant implications for companies and individuals. Here are the implications. We have for companies, we have penalties between 10 to 20% of unremitted withholding tax plus interest. So the interest is 5% to 10% per annum on unremitted withholding tax. So the penalties is based just one time payment on the unremitted withholding tax, while the interest will be increasing yearly, because this 5 to 10% is per annum. So if you refuse to WHT, it's the interest will start increasing depending on the years you have failed to deduct the withholding tax. So we have fines, which is from 50,000 to 500,000, depending on the project. We have tax audit. FIRS may conduct an audit to assess compliance immediately. We have reputation damage. You can damage the reputation of the organization because you did not remit the withholding tax. So non-compliance may harm business reputation. I said legal actions. FIRS may prosecute directors or officers in this organization. So that is for complaints. For directors or officers, we have personal liability. Director or officers may be held personally liable because there's no ignorance in law. Prosecutions, directors stroke officers may face prosecutions. Fines, they can also face fines, which is from 50,000 to 500,000 approximately. They can be imprisoned up to 3 years. So you must file your withholding tax to avoid all these penalties. So for supplier, we have for suppliers and contractors. We have we have other implications. We have delayed VAT refunds, integrity of tax credit, inability to claim input tax. FRS may deny certificates of compliance, negative impact on credit ratings. I'll see this in the notes. So we have remedies. We have voluntary disclosures. Companies may disclose and pay on remittance withholding tax. Payment plan. We have FRSC may approved payment plans. That is remedies. Waivers of penalties. FIRS may waive penalties in exceptional cases. So regulatory body, like I said, FIRS, Federal Inland Revenue Services, Nigerian Tax Authority, SIRS, State Internal Revenue Service. So relevant law, we have SITA, we have VATA, we have FIRS again. Let's move to penalties for failure to remit withholding tax. So the first one I talked about was penalty of failure to deduct, and you refuse to deduct it. So the second one I'm talking about is failure to remit. It means you deduct it, but you do not remit. I said once you deduct, you are meant to remit it in the next 21 days. Or you face penalty. So like I said the period of filing on WHT is 21 days. After the duty to deduct arose from deduction from companies, after you've deducted it, you have just 21 days to remit it to the government. The penalty for failure to deduct the remit tax is 10% of the amount not deductible and remitted. That is the penalty. So once it is more than that period, when it is going to a year, you have to pay interest too. So this 10% is always variable in 11 months. Within 11 months, once it is a year, you have to pay interest for that year because you've used our money to invest. So when the profit comes for you, we take out of it too. So let's compute the penalty using given rate for non-deductible and non-remittance. Penalty for late remittance and non-deductible of withholding tax for payment. I think I've talked about the non-deductible. So this 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 one will be mainly on. I'll mainly talk on penalty for late remittance because we talk about the non-deductible. So they said in section 82 of CETA 2008 as amended specified as where any person will be obliged to deduct any tax under section 78 deduction of tax from interest etc, 79 deduction of tax on rent, 80 section 80 deduction of tax from dividend, or section 81 deduction of tax at source of this act fail to deduct or having deducted fails to pay for the FIRS within 21 days from the date the amount was deducted or the time the duty of deduction arose shall be guilty of an offence and shall be liable to a penalty of 10% per annum of the tax withheld or not remitted as the case may be. Similarly, failures to deduct or having deducted fail to remit to the state board within 30 days, withholding tax withheld from payments due to individuals shall be guilty of an offence punishable to convictions and shall be liable to a fine of 5,000 naira in addition to the tax deductions or deducted but not remitted plus interest at the prevailing commercial rate. So you have to note that withholding tax deduction from payments due to companies are payable to the FIRS. I think I talk about that. Then withholding tax deduction from payments due to individuals are payable to the State Inland Service, that is SIRS, where the recipient is residents. I think I've talked about that. Then the withholding tax deduction are payable to the FIRS, where the payments are due to residents of the FCT, Abuja. Withholding taxes on dividend, interest, rates, and royalties when suffered by non-residents represent final tax. I think I've talked about that because that one you have to deliberate before you give it out. It's one-time payment. It's not like projects. It's not like projects where you have to come out with the actual expenditure. So we have questions on withholding tax, and if you can solve the questions, then you are good to go on withholding tax. So question one here, I have briefly highlight the main features of withholding tax. We have features means characteristics of withholding tax. So we know you have to pay them in 21 days. We know it has rates. So in my answer, we have payment of withholding tax is statutory on a person making the payment, like it's compulsory, it's mandatory, it's not a choice. Number two, I have withholding tax credits cannot be used to offset tax liability of prior year. I talk about that. Once you have tax credit, you have to use it that year to offset your other liabilities. Prior years, it won't be useful again. So they said it is an advance payment of income tax, which is utilized as tax credit against the income tax liability of the year to which the income relates. You deduct withholding tax on income, taxable income. All incomes are now taxable income, so you deduct it from the source. So I also have withholding tax represent the final tax on frank investment income, or dividend income in the hands of the recipient. So they represent final tax. Once you pay dividend, you pay it. So number two here, I have state the relevant tax authority in relation to withholding tax of Nigeria. I talk about FIRS, I talk about SIRS. So one is inland, the other one is internal. So another question is, I have enumerate the context of a payment schedule for the remittance of withholding tax. So the answer here is the content of payment schedules for the payment of withholding tax. So the content of payment schedules means information that will be on the it is called payment schedule, because you don't just pay withholding tax. You don't just give us rates without where the rate is coming from, without the source of the rate. So we call that payment schedule for withholding tax. And what they want to see there is the names of the taxpayer who suffered the deduction. Taxpayer is you. I gave you a contract and I'm taking withholding tax from it. Then your name will be recorded, will be on the payment schedule. So we have the addresses, we have the nature of their activities or services and period covered. We have the tax file number, the thing is very compulsory. We have the amount, total amounts payable, the amounts you approved. We have the rate of tax applied, the rate you applied for that particular thing. We have the amount of tax withheld. We have the balance paid to the taxpayer. We have the tax contracts for which return were being made. We have the date of payment, and we have the check number and date. So I have other questions that has to do with what is tax implications of it. Okay, let me read a question for you. Asheye Insurance PLC engaged the service of Desu Consulting Limited for corporate restructure and strategic management in line with the ongoing recapitalize exercise within the insurance industry in Nigeria. So Asheye Insurance is a company and it needs the services of Desu Consulting Limited, which is also a company. So the fee for the assignment is 65 million naira. This is company to company contract. So I said, as the leading company in the new mega insurance company, Ashaya Insurance paid the agreed fee on June 30, 2013, upon which no withholding tax was deducted. He gave him the 65 million naira without removing withholding tax. Does that require what is the tax implications of these actions? So the answer is the tax implications of Asheye Insurance PLC for failure to deduct, according to Section 82 CETA 2024 as amended, is that the company will be liable to a penalty of 10% of the tax withheld or not remitted in addition to payments of the tax itself. Specifically, this is equal to payment of the penalty, that is 10% of the tax. What's the tax? The tax is on 6.5 million. That's the tax. Payment of the tax, that is 10% of 65 million. So you are going to pay two payments. The real tax which is 6.5 million, that is 10% of 65 million, plus penalty of 10% on that tax, that's 50,000 naira, plus 6.5, that is 7,150.